The world is currently drowning in over $315 trillion in total debt, nearly 3 times the global economy. Major nations, including the United States, $38 trillion, the European Union, $14 trillion, and Japan, $9 trillion, carry enormous burdens. The core paradox is, if every country owes money, who is the creditor? The unsettling answer is that the world essentially owes the debt to itself. Debt is the invisible scaffolding of the modern financial world, where every government, bank, and citizen is simultaneously a debtor and a creditor. The birth of the bond. The concept of national debt was not born in finance, but in war. 1694 England. To finance a war against France, the king turned to merchants, promising them a permanent stream of interest payments backed by future taxes. The government bond. This arrangement led to the creation of the Bank of England and the government bond, a tradable promise. This was revolutionary, allowing the state to spend money it didn't yet have. Credibility. National debt became a measure of a nation's credibility. The ability to borrow was the ability to rule. The circular system of US debt. The US debt is a prime example of this circularity. Who holds the debt? Most of the $38 trillion debt the US owes is owed to America. Roughly 2/3 of the publicly held debt is owned by American institutions like banks, pension funds, and the Federal Reserve itself. Foreign holdings? Only about 1/3, or roughly $9 trillion, is held by foreign nations, primarily Japan and China. Claims that the US is primarily in debt to China are misleading, as China holds roughly 2% of the total. Global circulation. This circular system is global. Countries hold each other's IOUs, e.g., Japan lends to the US, which lends to Europe. It is a planetary game of promises, secured by further promises. The arbiters of credit. The system is managed and manufactured by 2 powerful forces, markets and central banks. Markets, institutions like hedge funds and pension funds, are the true arbiters of credit. Their confidence dictates which nations can borrow cheaply. When that confidence fades, currencies and economies can collapse. Central banks, the Federal Reserve and others, don't just manage debt, they manufacture it. When a central bank buys government bonds, it creates new money in exchange. Every dollar in circulation represents a unit of debt somewhere else. There is no such thing as debt-free money. The policy. Perpetual refinancing. The central secret of sovereign debt is that it is not designed to be repaid, it is designed to be rolled over, refinanced forever. A rolling subscription. Governments issue new bonds to pay off old ones, making interest the real product, the rent charged for stability. The safest asset, a US Treasury bond, is considered the safest collateral in existence. It is viewed as a foundational asset by banks and pension funds globally. The necessity of debt. Paying off the $38 trillion US debt would shrink the dollar supply and destroy the world's most stable financial instrument, triggering deflation and collapse. Therefore, governments must keep issuing more debt to keep the financial system functional. Debt as a class transfer. While the debt loop keeps the global economy stable, the benefits are not shared equally. Upward flow. The interest payments funded by taxpayers and workers flow upward to the institutions and investors who hold the debt. Inequality. Debt is not just a transfer between countries, but a transfer between classes. This is why global inequality and global indebtedness rise together. The system rewards those who own the debt and punishes those who merely pay it. The stability of the entire system relies on a closed loop of trust. If that belief ever breaks, the economy, built entirely on these rolling promises, grinds to a halt.